But I have to say, since I published on that, just a month ago, my outlook after the first month of 2024 has changed in that there have been game changers amongst the major players in the uranium space, particularly the world's largest and lowest cost producer, Kazatomprom, has slashed its forward guidance. And actually, even more shocking to me, it produced less uranium. Never mind, the guidance was to increase production, which it failed to do. But it actually produced less in 2023 than 2022. That was a real eye-opener to me.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. You all know the drill. Every time I bring on a new guest, I have to give an introduction. And so today we have the pleasure of welcoming Lobo Tiggre. Lobo is the author and founder of the Independent Speculator. He focuses on speculation in natural resources and precious metals stocks. He does his due diligence and operates with integrity to be sure to give viewers and listeners a realistic perspective and a realistic view on what's going to happen in the markets in terms of natural resources investing. So be sure to hit the subscribe button and the like button if you enjoy this content. And without further ado, let's get to the interview. Hey Lobo, glad to have you on the channel today.
And I'm happy to be here.
Yeah, so we met at the Rural Symposium, then we met at the New Orleans Investment Conference. I always appreciate your views that you bring to the table. I've learned about you just through Rick, and then also hearing from Doug Casey as well, and then listening to your work as well at the Independent Speculator. It's really amazing just how you bring a sober and realistic view. I consider you a realist.
Well, thank you. That's a compliment. But, the marketing people tell me I do everything wrong. My readers tell me that, I deserve to have 10 times the followers that I do. But on the other hand, if you fall into the clickbait trap and you say whatever the crowd wants to hear, what give them fresh meat to the mob. You're the hero for a day. But long term, I think it's better to try to be right than to be sensational.
Yeah, agreed. And one source that really pointed me to you, because I've always heard about you, and then I read a lot of Lynn Alden's work, and so Lynn Alden had pointed to you in one of her newsletters, and she was really just honing in on the fact that you do some really good research and you're not sensational and things of that nature, which I consider her pretty level-headed as well, and not feeding us the bullish narratives of gold's going to 6,000 and things of that nature that we hear on YouTube. So I'm really appreciative of your work.
Yeah, I have enormous respect for Lynn, and I think in many ways our work is compatible in that she's not the due diligence guy or gal for your junior resource mining stocks. That's not her specialty, and her grasp of the macro, I think, is broader and deeper than mine. So I think it dovetails well. And certainly if I had crypto questions, I'd hand them to her. That's not my bailiwick.
Yep. Understand. So talking about macro, you posted some charts recently on Twitter. And so I'm going to go ahead and share screen here because I think it'll be good for the audience just to see some of the content that you're posting on your Twitter account, because you post some really good charts and everything. And so if you are not following Lobo, be sure to go follow. And so
while you're doing that, let me just quickly say, it's funny. I got some help with my Twitter account. I have a help with the memes. I don't generate all those memes that are so popular. It's a collaboration, but there's a genius. His name is Kyle Johnson, who works with me, and I'm very happy to have him. But I'm only mentioning this because when we started working together, he says, you're a source, you're not a news aggregator. You should focus on X, Y, and Z. I said, well, actually, I am sort of a news aggregator. In the first place, as an investor, as a speculator, I need to check on the news. Anything that's going to affect commodities, resource markets, I need to know about. So I'm looking at the news anyway. And it only takes a moment to to tweet about it, right? What catches my interest. So I actually see this as, it's not just a nervous habit or something. It's a communication tool where I'm trying to highlight to my audience trends and factors that I think are important for resource investors.
Yeah, you posted a few in the last couple of weeks that really caught my attention, and a few that's made me laugh as well. So I love the humor in there. And so speaking of, shout out to Kyle as well. Just shout out to Kyle being in the background doing what you do. Appreciate you. So on this recent tweet, you posted about the inflation numbers. And so could you explain to the audience what's happening here? Obviously, we see that there's a difference between the core inflation rate and the inflation rate year over year. And so what's happening here?
So the most striking thing is, okay, I'll get to core versus headline, but to me, the most striking thing is that you have both numbers up, whether it's core or headline, the monthly numbers are up. And that's what, as we're recording, the Dow's down 500 points, the markets are reacting like a stung bee to those monthly numbers. The funny thing, though, is if you look at the yearly numbers, the core is flat and the headline number is actually down substantially, from 3.4 to 3.1. That's by inflation standards, that's a notable drop. We're getting close to that holy grail of 2%, that arbitrarily determined nirvana of 2%. So, inflation's down. Why the upset? Well, there's two ways we can go. One is, how much do you want to talk about inflation, and how much do you want to talk about the market reaction? But to answer my question, why the upset? Well, the monthly numbers were a surprise. People think the Fed, and been told the Fed is beating inflation hands down. Team soft landing is morphing into team no landing. And people really think the Fed's beating inflation and everything can go back to easier monetary policy without a recession or any, bigger lumps to pay. So the monthly numbers are a bit of a shock. Now, why are the yearly numbers so different? Well, that's the base effect. You may have heard about the base effect, and bearing in mind that these numbers are increases over the previous time period. So if the previous time period was a big increase, then for the next one to be an equally big increase. The bar is this much higher, right? If it comes in the same as it was the previous period, it's actually still an increase over before. I'm not sure if all my hand waving is helping here, but I hope it does. You raise the bar, and that makes it harder to go higher afterwards. So this is, I think, an object lesson. If you wonder, well, how important are the base effects? Does this matter? Well, this shows you. I mean, look at the headline inflation dropping significantly, even though the monthly number was an increase. That's entirely due to how big it was a year ago, which is your base effect. So I'm not sure where you want to go, which direction we want to go there. But just real quick on the market reaction, I'd say the reason for the stung by a bee response is they were still, I think, a lot of people rather idiotically thinking that there would be a cut next month, that March was still on the table. The Fed, not just Powell, but all Fed speaks has been, very much pushing back on that idea. But the bond market, the pricing has been telling people March was still on the table. So I think this is the rug pull here. And the funny or sad thing is it doesn't really change the macro outlook at all. The Fed guided for 3 rate cuts this year. They never said that they would be in March, or let alone January, right? They didn't say when. And to the degree that we believe them at all, they've been saying later this year. So this actually doesn't change that scenario. In my view, it's much more important that, as many of us hard, money advocates and gold bugs have argued, that inflation was going to be a harder beast to slay than the Fed and its cheerleaders have been saying. And so this evidence of sticky inflation, I think that's the key takeaway. That's the point to remember, is that despite everything team soft landing, never mind team no landing, is telling you, inflation is sticky. It's not going away as quickly or as easily as people thought. And, that opens a Pandora's box of possibilities for, what the Fed might have to do to beat it, or if they start cutting without beating it, what does that do?
Mm-hmm. Yeah, that's very true. So which this also leads to the question about recession, because if the Fed cuts, I mean, usually the Fed cuts when something's bad is happening, right? I mean, they started cutting, in 2008. They started cutting, I think they were cutting in 2001 as well. They started cutting in not cutting in 2008, right? They were tightening at that 2018. They were tightening at that time. And so
Yeah,
if the
the first Powell pivot, right?
yeah,
If we
yeah,
include the balance sheet as well. Sorry, let me jump in and say,
yeah, go ahead.
yes, but not only, right? The Fed will cut in response to a recession or systemic risk. They've told us now that even with high inflation, they would have cut if the banking crisis last year hadn't been contained, right? That posed systemic risk. They would have acted even though inflation was still high. But so you say that it's normally cutting as a response to recession. But the Fed has also told us very clearly, multiple Fed heads have said this, that policy is already restrictive, and they think sufficiently restrictive. Nobody really knows what that is, but whatever that is, they think that's at or close to sufficiently restrictive. So they don't want to make it more restrictive. They don't want to raise rates now. The question is, when do they cut? And this matters because, okay, the monthly numbers were disappointing this time, but the yearly number went down. The headline number went down. Core was flat. And so overall, the numbers come down quite a bit from 9. And people are saying, oh, well, that last mile to 2% is a long way. I get that. But still, 3 is a lot lower than 9. It's lower than 4 or 5, pick your rate. So if they don't cut and inflation continues to fall, then that restrictive policy, the difference between the inflation and the Fed rate or the benchmark, 10-year or whatever, that will widen. So that will make policy more restrictive. Like doing nothing is more restrictive if inflation continues to fall. And so they could cut, and they've admitted this, or not admitted, they have said that, yes, that would be a reason to cut, even without a recession or a problem, to maintain an equally restrictive policy, since not cutting would make it more restrictive. Does that make sense?
Yeah, for sure. So here you give the New York Fed's 3 to 10 indicator that's still predicting recession. Also, if we look at the U.S., the leading economic index, it's still showing recession. So what does this lag effect look like? So policy has been restrictive for a while, and we're paying a huge amount of interest on the national debt. I mean, people were feeling the pain of high interest rates and inflation, if people want to believe that, the inflation numbers are true. And so what does this lag effect look like? I mean, it seems like it's taken a while to pan out, and people are starting to fall into like the bullish narrative of no landing, soft landing, which, I mean, that itself, I mean, shows that you may want to be a contrarian. If many people are going towards this side of the boat, you may want to stay on the other side. Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tiggre, and more. Rick even organizes the Living Legends panel, where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Yeah, if it's darkest before the dawn, or inverting that, it's when the bears give up that you're in your maximum point of danger. Because if there's capitulation amongst the bears, prices change, and then the markets turn or the situation turns, that would be your fulcrum point of maximum leverage. So it could be an interesting indicator that the bears are giving up, and they are, at least mainstream bears, maybe not gold bugs, but the types you see on Bloomberg or Yahoo Finance or whatever mainstream financial media you like, Wall Street Journal, the bears are giving up in droves. So several points. One is, I think it's incorrect to say that the Fed has beaten inflation without causing any major problems. I mean, we did have the banking crisis of last year, and they say, oh, it's contained, it's no big deal. They did contain it, but it was a big deal. The measures that they put in place to contain it were emergency scale measures, bailing out banks wholesale across the board, giving them par for paper that was deeply in the red. That's not the sort of thing you do if everything's fine. That is an emergency response. So, we had that. We had an earnings recession. We had a freight recession. We certainly had a manufacturing recession. The so-called rolling recession was, quite evident to anybody, I think, level-headed watching the economy last year. It's just this one pillar of the strong labor / consumer that everybody points to as the definition of a robust economy. But it's not. It's one part of an overall economy. So that would be the first thing. It's just, I don't think it's true to say that there's no price to pay. And if you talk to the average person who goes to the supermarket and looks at, what they're paying for their groceries and what is their quality of life now, I think that person will tell you that there certainly was a price to pay for the Fed's tightening. As far as the lag goes, there are different numbers out there. I saw a recent one by the RBC that projected a longer average than I'd understood. I had heard 18 to 24 months was the typical delay between a pivot to policy tightening and a negative impact on the economy, 24 to 18. I say 18 to 24 months. By that older standard, we're just getting that average number now. The new RBC number I saw was 27 months, which puts it, the average, mind you, not it's too late, not an expiration date, not it's safe to get in the water, there's no chance of a recession. Just the average delay from policy change to negative effects, according to the RBC, is 27 months. So that'd be June, July this year. Like, we're not even there yet. So now, there are clearly circumstances that are different this time. The post-pandemic distortions in the economy are historic. We are truly in uncharted waters. So, could the long and variable lags be even more longer and variable than typical? Why not? We're in uncharted waters. But however that turns out, the bottom line is that all these people saying, and I have heard this on mainstream media, that if there's no recession by now, we're not going to get one. That's simply premature, even by conventional metrics. Right? We are just now getting into the zone where it's the average of those long and variable lags showing up to bite you on the posterior. I think it's an important thing to keep in mind. You put that with the bear capitulation and so on, it could be an interesting time to speculate as a contrarian. I do want to say again, though, stress the uncharted waters thing. It's amazing how many people say, yeah, uncharted waters, but here's my chart. Let's do this. That's a dangerous thing to do. The labor hoarding post-pandemic, I think, has really has changed things. And we'll see. We also know that the pandemic established no fault of their own as a justification for sending people thousands of dollars in stimmy checks and any number of other responses. So there's a lot of people that are saying, oh, okay, Lobo, if you're right, and we're still going to have a hard landing, well, the markets are going to tank, we should short the S&P and, we should get, market crash insurance. But that's not necessarily the case. We've seen, the Fed is doing their best to kill the Fed put, right? But that's the experience. That's what we've seen time and again. And it's not just the Fed, it's Congress and the stimmy checks and so on. So in a bad news is good news world or economy, in a government distorted, bad news is good news economy and stock market, this is a key takeaway. Me being right about the recession could take all three major U.S. stock indices to much higher new record highs. Crazy as that may sound, the stock market is not the real economy. It's a different beast.
Yeah, that is true, and that's why I really like the book "Permanent Distortions" that Nomi Prince wrote out, and she laid out how the Fed involvement in the economy has distorted, just permanently distorted everything, and so it's very interesting. So just transitioning to metals, right? So many people have heard your take on gold and how that is your asset. I believe that's your asset for the year. And so, and you're looking at more of the gold equities. I mean, those are the ones that have been killed. A lot of people have, given up, thrown out the towel, and everything. And then I heard that you use the actual physical metal as insurance, and so that's what I use it for as well, insurance for my wealth, because it is legal money. And so, what's your outlook on gold this year? Are you, if we do get some type of drawdown from a recession, usually everything gets hit. So I remember in 2020 when gold actually went down for a short amount of time and then bounced back up pretty quick, and that's probably people needing to get liquidity. And so, what's your take on gold for this year?
All right. Well, you've put several threads there to follow up on, but let's first separate gold itself from the gold stocks. It's an important distinction. This is a famous Doug Caseyism. One of the first things, I guess you could say he taught me. It's kind of obvious when you think about it, but it was an important principle that he hammered home time and time again. The reason to own gold is for prudence. You can look at it as insurance. I look at it as money. I look at it as my long-term savings. I only keep, cost of living expense type money in my bank account, and my long-term savings go into bullion. And we were talking before about, if about the possibility of a market downturn, which you've just brought up again. And I said, well, maybe bad news will be good news. There will be no downturn. But if things do turn south, that's the beauty of having insurance. That's that's what helps you to sleep well at night. If everything else goes crazy, if the worst comes to worst, then you've got that ultimate form of liquidity, which is why it does spike, as you pointed out in 2020. It's not that gold fails in a crash or liquidity crunch scenario. It did the same thing in 2008. It's that it's being drawn upon. It's being savings dipped into when people are getting margin calls and there's no bid on anything else. People will dip into their savings to cover their bills. That's a great thing to be able to have that reassurance. So, I'm not bullish on gold, or I'm not buying gold bullion because I think the price is going up in this year and I want to make money that way. If I did, by the way, I'd buy an ETF because I wouldn't have to pay the premiums on, physical, coins or bars and take delivery and storage and all that stuff. If I'm speculating on the price movements, so I'll go with some paper equivalent, the Sprott physical or something. But no, savings, I want the physical. I want to hold it in my hand. I want it to be a financial asset for which there's no short, right? It's a thing of beauty. The context, though, for this year, the outlook for gold this year is that I do think the gold dollar exchange ratio will go up. And I think it's a fantastic setup that we're going into an environment, recessions are good for gold historically. Rate cuts are good for gold historically. If I'm right about the weakening U.S. economy, then that shifts the Forex market. So it's good for the euro and alternatives to the dollar, including gold. So there's a number of factors that I think are very bullish for gold this year. And if we're going into that at plus or minus $2,000 in the gold dollar exchange ratio, that's fantastic. The last time we had a situation like this, we're going into it around 1,500. And the time before that, we're going into it, around 1,000. And we get these huge legs up when we get one of these big breakouts. The numbers get kind of clickbaity, and I don't even want to say what the numbers are. The audience can do the math. But if we're going into such a situation where we have frequently seen something on the order of a 30 to 50% rise at 2000. Well, just, 10% is 2,200, 20% is 2,400. And those are numbers that would absolutely be making headlines and getting a lot more attention into this sector. So interesting times. And again, there's the gold stocks for prudence, but in this environment where I expect higher prices, the safest thing to do would be to buy an ETF or something, but I want leverage to that price movement. So that's why I'm looking at the gold stocks. And as you mentioned, they're in the doghouse. Nobody loves them. They've underperformed, blah, blah, blah. I think that's, if not the term perfect storm is sort of overused, but this is like that. And by the way, for people who are already saying, oh, gold bug likes gold, this is no headline, this is no big deal, broken clocks right twice a day. Well, last year, my metal or my commodities trade of highest conviction was uranium. So it's not like I'm an always gold all the time kind of person. So this year, I've said that gold is my highest conviction trade. And in that context, I think it's terrific that the stocks are on sale. Okay, there are some companies that have failed or have problems, but the babies have been thrown out with the bathwater. Some of the best companies in the space are very much on sale. So, in that kind of bullish scenario, to have a chance to be able to still buy low, like it's incredible. Here we are, $2,000 gold. I remember when I started in this business a couple of decades ago, we were hoping to see maybe $1,000 gold someday. We thought that $1,000 gold would be like nirvana if we could ever get that high. Here we are at $2,000 gold, and people hate the gold stocks. And priced in gold itself, many of them are cheaper than they were back then. It's an amazing opportunity to me to be able to have something that seems so obvious and yet is still on sale. Usually when it's obvious, you've missed the boat. You're not going to be able to buy at the bottom. And by the way, this is kind of the way I felt about uranium last year. It had spiked in 2021. A lot of people got irrationally exuberant, let's say, to be nice. And they chased the uranium stocks. There was this big spike. And then it consolidated, for years. And the stocks got hated. So going into 2023, it seemed to me that in the same way I see the stars aligned for gold now, the stars were aligned for uranium then, and people hated the stocks. So they were on sale. So there was an opportunity to buy low in the face of something that seemed obvious to me that had to go up. So I see the gold as similarly this year, but I have to say, since I published on that, just a month ago, my outlook after the first month of 2024 has changed in that there have been game changers amongst the major players in the uranium space, particularly the world's largest and lowest cost producer, Kazatomprom, has slashed its forward guidance. And actually, even more shocking to me, it produced less uranium. Never mind, the guidance was to increase production, which it failed to do, but it actually produced less in 2023 than 2022. That was a real eye-opener to me. So between that and all, some 9 million pounds that they had said they would bring to the market this year that are now no longer going to be brought, I see that market as more exciting again. The challenge there is that unlike the gold scenario where the stocks are hated and cheap, right? Many of the obviously better uranium stocks are at or near 52-week or even multi-year highs. So it's not quite the same buy low, sell high proposition that I see in gold. On the other hand, the probability of higher uranium prices, it seems very, very strong to me. I think it would take a Chernobyl scale event to derail that thesis, which makes me interesting in looking for any overlooked gems there or stocks that have pulled back significantly enough to be a good buy.
Yeah, that's really good because I'm very bullish on uranium too. I've been in the trade since probably about late 2020. So I experienced that first run up with, and a lot of that seemed like a lot of retail investors. And then last year, it seems to, with the government adoption and that whole sentiment changing, we had more institutional buying come in. And I'm kind of wondering, like, how is that playing out in the gold market as well? Like, obviously institutions are always like dabbling in whether that's like futures or or ETFs or whatnot. At some point, I'm wondering if the institutions will come in and be buying more of the gold stocks and
Well,
such.
clearly we have a major category of institutions already there, and that would be the central bank gold buying that we're seeing in record levels. Not in the West, but basically everybody else. It seems, this isn't the sort of thing that we can prove. That there's no document that we can discover in some dark smoke-filled room in the deep caverns of Washington, D.C. that's going to prove this. No smoking gun. But the correlation, the coincidence, whatever you want to call it, it's too much for just be a coincidence of the, weaponization of the dollar. And then suddenly central banks all around the world are piling up on gold. I think that's, clear as day. And whatever the cause, who cares? Maybe it has nothing to do with the dollar. I think it does, but let's just say we don't know. Doesn't matter. Central banks are buying gold hand over fist in record amounts. I think that has a lot to do with why gold has done so well, despite the Fed tightening, because, gold, infamously doesn't pay interest. So you take interest rates up to 5%, that's supposed to be bad for gold. And so all the people are saying, oh, well, gold should be 5,000 or 10,000 or whatever. I think they should be appreciative of the fact that it isn't 1,500 in light of the, stronger dollar, higher rates, the apparent victory of team soft landing, if not team no landing. I mean, there are a lot of things that you could say are bearish right now for a safe haven asset. But then we've got this other source of buying that's helped. But to your question with institutions, broader, I think you mean here in the US, brokerages, banks, that sort of thing, family offices. I think we're starting to see this. This is another of those things where it's sort of anecdotal. We're not going to be able to prove it. But it seems to me that the frequency of guests, not the talking heads on financial media and their own shows, but their guests are mentioning gold. And this isn't gold bugs. This isn't, Doug Casey or Peter Schiff or Rick Rule, right? This is mainstream financial types from XYZ Fund or, ABC Bank or something. And they'll say, yeah, we're doing this and we're going with, value now more than growth and blah, blah, blah. And then at the end, they'll say, oh, and we've also got a little bit of gold there as a hedge. Like it seems to me that 4 years ago, you never heard that. And I can't say they're all doing it now, or even most of them are doing it now. My sense, though, is that I'm hearing it, A, at all, and B, more than I have, it seems to be ramping up to me. And this is really, to me, it's very significant and potentially could be a game changer. Our friend Rick Rule likes to say or point out that historically, if you take the 50-year average of global asset allocation, the 50-year average is 2% to gold. It's not like nobody but gold bugs are going to put half their wealth in gold or something like that. But this is mainstream. This is global resource allocation, portfolio allocation, just as a bit of a hedge. The 4 or 5 decade mean is 2%. And currently it's less than 0.5%. So Rick likes to say that if it reverted to mean, we'd have 4 times the investment demand for gold, which would blow the market, way up. Maybe the world has changed. Maybe Bitcoin has taken some of that wind out of gold sales and gold's never going to go back to 2% allocation. You know what? Let's say it's cut in half and it only goes back to just 1%. In a world where we have 2 hot wars, either of which could become World War III, and all kinds of other shenanigans in uncharted waters, is it really unreasonable to think that just 1% of global allocation might go to gold as a safe haven in uncharted waters? I don't think that's unreasonable at all. And that would double investment demand. If investment demand for gold doubled, I think that would have a very significant impact on the gold dollar exchange ratio. So I can't promise you, yes, you're right, brother. Institutions are piling in. Here's the proof. I don't have that smoking gun for you. But my sense is that this is happening. And it'll be interesting to see over the year or years ahead how much of a change we're looking at.
Mm-hmm. Yeah, that's really good. And so for someone who, may not be as like savvy and like picking gold stocks. So, I mean, you got multiple different layers. You got gold stocks, you got mining stocks, you got explorers. And I was introduced to explorers at Rick's symposium last year and looking forward to seeing you speak this year at the symposium. And so, you have the royalty streamers, you have the ETFs and things of that nature. So I personally have been more into the royalty and streamers. I've been buying up Franco Nevada since they've had their significant discount since November. And so, for someone who's like a little less risk averse, what part should they look at, or would you look at if you were risk averse, in terms of like ETFs or royalty streaming?
Well, the ETFs are the simplest way to go, but they basically offer you no leverage, right? There are actually 2x and 3x GLD ETFs. Like you can bet on with leverage to the underlying price of a commodity with those 2x and 3x. But they're not, I mean, they're not a company, or they're not a position. Those 2x, 3x, the funds are intended to deliver these like on a short-term basis, if not daily, then a short-term basis. If you look at those 2x, 3x ones, they can do that, on a day or a week when gold goes up or down. You'll see them do that. But if you look at a longer term, if over the course of months or years, they don't do that. And you have fees for this too. So I would not say, okay, I'm just going to buy a 2x or 3x gold ETF instead of a gold miner for leverage. If I want leverage, I go with the miners. If I want more leverage, I go down the food chain, to a junior that can be a 10x or 20x winner, right? Which your big boys are never going to do. Your question was, though, if you're more risk averse, the pure way to just play the metals themselves is the non-leveraged ETFs. Those are a safe way to park cash, just waiting for the underlying metal itself to go up. And then from there, you take on a little bit more risk with the major producers, and you have more leverage to the upside. The majors, they're in the doghouse now. The gold stocks are hated now. The apparent historical relationship appears to have broken down. Now, I think that's an aberration. I think it will change. Historically, though, if say gold goes up 1%, the producers will go up 3, 4, 5%. And so that's the leverage that you get there. Now, you do take on risk if a producer, has a mine nationalized or something like that. There's greater risk than just the ETF on the metal itself. But the bigger players are, most of them are. Well, I think all the bigger ones are not ancient, but older companies. They've been around a long time. Management is deeply experienced. They know how to mitigate risk. And if they're bigger, the disappearance or underperformance of one asset isn't the end of the story. And we've had cases. Well, so like, let's take Barrick. I'm not recommending the stock for or against. They've had more than their share of lumps with Papua New Guinea and other setbacks, major assets that have gone offline or become problematic. But then on the other hand, you've got Reki Dick in Pakistan coming back from the dead. So, when you have a big company like that, you can lose something here and then gain something there. That you have some risk mitigation through size and diversity in the portfolio. Again, I'm not recommending the stock. I'm just giving it as an example of one where you'd think that, having the government just up and seize 50% of your mine would be fatal. But no, not for a company that large. So that's the next logical step. Now, people like to say, oh, there's a food chain, right? You have the majors and then the mid-tiers and then the juniors. It's not quite like that. Actually, it's very rare that I like a mid-tier because you have sort of most of the risk of the juniors, but you have less of the protection of being a larger go-to stock. Oh, that's an important point. The other thing about the majors, it's not just that they're bigger and safer, it's that they're well known. Your Barricks, your Newmonts, and some of the other big names in this space, kind of everybody knows about these. So let's say gold does break out, goes over 2,200 and stays there and heads towards, JP Morgan, not gold bugs, are predicting 2,300 gold by the end of this year. Let's say that's where we go and people start getting interested in gold. They're not going to go to Moose Pasture Exploration Inc., right? That's not the first thing they're going to do. They're going to go to the well-known names, the go-to stocks. So that's another reason for betting on these. If there's a breakout, they will give you leverage to that breakout.
Yeah, yeah, and it's funny you mentioned J.P. Morgan. The spoofers are,
Yes, right. So these are not the most gold friendly people in the world. And even they are saying 2,300. Citi has a 2,200 target. It's down slightly from before. But 2,200 is a it A is a nominal new all-time high. And B, it's significant. It's a big round number above anything we've ever seen before in the gold dollar exchange ratio. So that would get headlines. There's potential here. I'm not promising this. This isn't a prediction. But if JP Morgan's right, along the way there, gold is going to be making so many headlines from, new nominal all-time high after new nominal all-time high. And I keep saying nominal because in real terms, it needs to go like over 3,000 to really hit. I don't have the current number, but to hit an actual inflation adjusted all-time high, it needs to be a lot higher. But even just the nominal all-time highs, they'll be making headlines left and right. Even these people who all they care about is Nvidia and Chipotle or whatever the market darling of the day is, right? They will start paying attention when gold is making headlines like that. So there's potential for it to become a flavor of the day. Wall Street bets could get in on the act. Who knows? We could see some interesting squeeze going on in this space. And by the way, it's just because you like uranium too, I'll say I also see potential for this in the uranium space. Again, I'm not predicting this. This is not my reason for buying uranium stocks. But uranium has become politically correct now. Like carbon is now the ultimate devil element. Uranium now is part of the solution. And it used to be that, a few years ago, there was a couple of heretics in the climate change movement saying that, maybe we ought to reconsider nuclear. We could really use the help. Now that's becoming an accepted position. We've got 28 countries after the last COP meeting or COP out meeting saying they want to triple their nuclear power generation in the coming decades. That's huge. I think the climate change camp is in such a state of panic that they've realized they're just not going to make it without nuclear. They're not going to reach their goals without nuclear. So if in that context you've got supply constraint, you've got the low-hanging fruit of mines coming back online, not able to meet demand, and you've got this increasing demand, and then if you've got this politically correct tailwind here, uranium could become the flavor of the day too. And if you think the flavor of the day can put a squeeze on gold or even silver, uranium is a much tinier market. We could see insane prices in there, and I don't want to give any numbers because it'll sound too clickbaity. Again, we don't need this to happen. Supply and demand are my friends here. The trend is my friend. I'm very happy with where uranium is going anyway. But if Wall Street bets and the climate, the green investors get hold of this, we could see some really spectacular price action this year.
Mm-hmm. And so for uranium, even for me, like I got in early, but I don't feel like I had a large enough position. So I've even been averaging in on the pullbacks, just because I think that the price is going to go significantly higher. So even at these prices, though some people may be in at the lows of 2020 or whatnot and may have just accumulated a lot of shares. For me, I'm still buying now when there's pullbacks, because I just think that we have not seen what this market can fully do yet. We got a glimpse of it, and I don't want to sound like just ultra bullish or whatnot, but just there's no solution to the supply side right now.
Yeah. And then I don't know how far you want to go down this rabbit hole, but there's also the scuttlebutt now about enrichment and the US potentially banning not just Russian uranium, but enriched uranium. And what will that do to the market? Yeah, I'm not the uranium insider here. I would actually recommend people go ask Justin Hune questions like this because he has much more knowledge about the uranium fuel cycle than I do. I'm a fundamentalist who likes the commodity. There's arguments that this could, ultimately create a lot more demand, in the West, and that would be good for Western projects and companies. Okay, I get that. There's also arguments that the disruption could be bad. If the Western enrichment capacity just isn't there to handle, like you don't sell your mine product to a power company. I will say that, right? You have to sell it. It has to be enriched and converted to UF6 and enriched and so on. So if that's a bottleneck, if that becomes a bottleneck because the Russian enrichers are offline and there just aren't enough yet in the West, then where are you going to sell your uranium? Maybe Spud will buy it all. I don't know, but there's potential there for this to cut both ways. Now, as we're speaking, just yesterday, it turns out that one of the enrichers came out and said, "Oh, we can meet demand. There's no worry. We have the capacity." And I asked Professor Quakes about this. He's one of my sources on Twitter, not unique to me, very, very knowledgeable. And he thinks that's true, but it would take time. As I understood his response, there are plans for the West they're already doing it now. They're getting billions, even from the Biden administration. That's really striking to me that the Biden administration, it's not just evil Republicans that are giving billions to nuclear energy. It's Biden. Anyway, so if that money is going to increase production in the US or in the West, as I understand it, it's going to take till 2028 before all of that new capacity is online. So if there's an overnight ban, not phased in, but an overnight ban, or if there is a phased in ban and Putin says, fine, I'm taking my marbles and I'm going home. You can't have any of my uranium. I could see a disruption here. And whether that's good or bad, uncharted waters, we'll see how it goes.
Yeah, yeah. And it seems like there's also a national security issue as well. I mean, I've seen some headlines about, I think it was Iran with enriched uranium and such. And so it seems like the U.S. would need to we would need to get our enriched uranium and our own sources and things of that nature. Do you see anything?
Well, the DOE, Department of Energy, never mind the Department of Defense, they're probably not going to give up any of their uranium, but the Department of Energy has a stockpile. And the press release that I saw about the enrichment, the last one that I saw, it said in there, I don't remember the sources, but the US government is ready to pitch in with supply in case of an emergency. Like, let's say the Russians just take their marbles and go home before the West is ready. Apparently there is supply that the government can kick in to smooth things over. Or let's say price goes through the roof and there's supply out there, but you have to pay through the nose for it. They're talking about subsidies, or they're talking about emergency grants or something to make sure that we still have access to that supply. So, if they're going to kick in with subsidies and grants and things, I think that's probably, I'm a libertarian. I hate subsidies. I don't think they should exist at all. But, we live in a non-libertarian world. If the government's going to throw money at it, prices are probably going to respond vigorously to the upside.
So we have a strategic uranium reserve, pretty much.
Well, the new one, but that's just U3O8. We're talking, we were talking about the enrichment. But sure, yeah, there's if the petroleum reserve can become a political reserve, why not uranium?
Yeah, that's true. That's true. So our audience, they want to know about silver. We got some silver bugs here. For me, honestly, I think the audience may not they may not agree with my take on silver. I still have my stack, at home and such, but I'm just I don't know, Lobo. I just have not had a lot of conviction on silver as much as I have gold.
Yeah, well, I've been famously dubbed Darth Silver by the Wall Street silver crowd for daring to say that, actually, my Darth Silver thesis is not a bear case. I'm not bearish on silver, but I am saying that it's visibly, measurably, the use case has changed. The industrial side of silver has always been much stronger than it was for gold, but it's much, much stronger now. There are some industrial use cases for gold, but not that many really, unless you count jewelry. But silver, it seems every week there's some new medical application, some new energy application. And then, of course, there's just solar, which is going nuts by itself. It seems like we're going to pave the planet to save the planet. But anyway, that's just, I think, part of the reality. And we have seen repeatedly over the last couple of years, many times where silver, that you just look at the charts, it looks a lot more like the copper chart than the gold chart. So, whatever we think should be, and yes, I understand silver is the word for money in many languages. I have more physical silver than I do gold, at least by volume. Not by dollar amount, by volume. I like silver. In a Mad Max world, where where we are using gold and silver, I'll need silver to make change for my gold. I get that. But it is just, I think it's undeniable that silver's industrial side is more and more important than it ever has been, and that is moving the silver to dollar exchange ratio. Now, even the most ardent silver bulls will tell you, and this is part of their argument, that silver typically lags gold in a bull market and then more than catches up at the end on a percentage gain basis. This is part of the sales pitch. So never mind my thesis, but if that's true, and we're going into a new gold breakout, that very idea argues for patience. Like, why would I pile into silver now if it's likely to lag before it catches up? I can wait for confirmation. I can wait for gold to break out, and silver, and even more the silver stock, should still be bargains at that time. Why get ahead of that? Now, on top of that, you bring in more of my Darth stuff. And, if silver's industrial side is more important than ever, and I'm right about the recession, and if in fact it is the recession that sends gold north, well, then silver seems like even more likely to underperform this time. It's also an industrial metal. We're going into recession. Industrial metals always get whacked going into a recession. I mean, just look at a platinum chart, right? So I just think that for both of these reasons, there's no enormous hurry to pile into silver right now. Now, that having been said, I have noticed, particularly since the second new war we have, or the renewed war, the Gaza conflict, that silver has gone back to mirroring gold more closely. And on days where there's no financial news, there's no economic news that would move them as commodities, but there's geopolitical news that moves them as safe haven assets, as the ultimate refuge. On those days, we have seen silver move strongly with gold. And I think that's very encouraging. So that tells me that no, the world has not forgotten silver, that no, silver is not only or just an industrial metal. It is still a monetary metal. It's still a safe haven asset. It still has that mojo. And so I am bullish on silver. I do not think it will be left behind in the next bull market or big breakout. That having been said, silver never did catch up with gold after the 2020 breakout. So, that I don't want to bet the farm on silver. I want to include it. I am betting on it, but I just think it pays to be cautious about assuming, some of the diehard silver bulls out there are like, yeah, it's the best, it's the cheapest, it's the most manipulated, the most potential, it's going to go 10 times higher than gold or whatever. Maybe. We don't know. I'm bullish. I think it goes higher. But the use case has changed visibly, measurably, and I just think it's incorrect to say that it for sure will outperform gold this time. It didn't last time.
Yeah. Especially with the nominal highs. Gold is near its all-time nominal high. Silver's still over 50%. And so, so it just makes it a lot tougher to, and then also,
Now, sorry, just real quick, on the bright side, if you're a contrarian, my argument is not to say, forget silver, hate silver. I'm not a silver hater. I'm just saying, don't assume that it will outperform gold. But as a base case, silver is going to go up with gold. That's the base case. I think that is a safe assumption. It's a bet. It's not a known thing. It's a safe bet. But if on top of that, it does outperform, silver is so hated right now, and so many of the silver stocks are on sale, so in the deep discount rack, that there's contrarian mojo here. Like, if you want to speculate on silver more than catching up with gold, I'm actually not against that, because I think, okay, let's say it doesn't happen, well, it still goes up with gold. It's not like it either goes way up or it craters to zero. I don't see any scenario where silver just goes away. And by the way, there are scenarios where gold does worse than silver. Let's say I'm completely wrong in my outlook. I don't know what I'm talking about. I'm an idiot. Team No Landing is right. We don't need no stinking safe haven assets, right? And gold just goes on a glide path down for the next 10 years. Silver would outperform gold in that world, because in that world, the economy is humming along, everything's hunky-dory, so your industrial demand for silver will go way up. So in some ways, silver is the win-win metal in this kind of scenario.
Mm-hmm. Yeah, and so sometimes, I think about, and I've heard people talk about the gold to silver ratio, and obviously, I mean, historically, I just don't think we're going to get to those historical ratios.
I agree. I agree. That's part of my Dar Silver thesis. The use case has changed, therefore it's just not a safe bet to assume that it must or will go back to the historical averages. And by the way, never mind the physical occurrence in the Earth's crust. A lot of people like to say, oh, well, there's 19 times more silver than gold in the Earth's crust, so the real GSR should be 19, or plus or minus. There are different numbers there, but plus or minus around 19. And I think that's absolutely just not true, right? There's more gold than platinum in the Earth's crust, and gold is blowing platinum's doors off because the use case for platinum went down. It's an industrial metal. So just because there's more, or just because the ratio in the Earth's crust of something to gold is different from the price, doesn't mean it has to converge on that, right? If I can think of lots of ifs or scenarios. Let's just leave it at that. There's no law of economics or written in the cosmic firmament of the universe that says that a price has to mirror the relative scarcity in the Earth's crust. There are many very scarce things on the Earth that are worth completely nothing. They're scarce but worthless.
Definitely. Well, Lobo, just one more question from the audience. So this is from, I consider him a friend, Neophyte. He asks, what piece of investment advice does Lobo value most that Doug Casey and Rick Rule taught him?
Yeah, Rick likes to say that your greatest enemy as an investor or speculator is to the left of your right ear and to the right of your left ear. And my way of putting that is going back to the ancient adage that you should know thyself. And I know this sounds like mushy psychology, pop psychology, but I really, really believe this is very important. If you don't know how much tolerance you have for risk, you will make mistakes. If you can't handle price and value diverging substantially, you will make mistakes. The intestinal fortitude you need to be able to say, no, the market is wrong. The value is here. The price is here. So I'm going to buy, or I'm going to buy more because I'm right and they're wrong. That is not easy. Now, it can be developed. I'm not telling people, if you're emotional, you're hopeless, go home and forget about it. But be aware of that, and maybe start baby steps. Start with the go-to type stocks. There's no risk speculation in the commodity space, but you can certainly start with the less riskier ones and develop your intestinal fortitude. And you go through a couple cycles, and you were right. Like, if you were with me on uranium last year, and there was so much hate against uranium because it just hadn't done anything for 3 years, come on, uranium, what's wrong with you, right? Like 3 years is somehow an important time frame. It's completely unimportant, but there was capitulation. So you ride a few adventures like that out and you were right, then that gives you enormous strength going into the next fluctuation so I quoted Rick to begin with, so I'll end up by quoting Doug. One of the main Doug Caseyisms is that price and value are not the same thing. And it's precisely because markets are emotional. They get overbought, oversold. I don't believe in the efficient market hypothesis. It's because markets are not efficient that there's opportunity for speculators when price and value diverge. That's a Doug Caseyism that I've taken to heart.
That's good. That's good. Good advice and valuable information. So what can the audience expect if they go over to independentspeculator.com?
All right. Well, we publish a great deal of free stuff, largely educational, broader market stuff. The one thing that I encourage people is simply sign up for my free weekly digest. If you do, you'll get to see how I think, how I write. You'll have my market takes and so on. Company-specific information is what paying clients subscribe for. But the free letter, I think, has a great deal of value on its own. I've had people tell me they pay for it. Here's the one thing I'll promise. You may not agree with me. I may get some things wrong. But the one thing I can promise you for sure is if you sign up, I will not spam you with a flood of daily advertisements. I hate that stuff. You get one email per week, and you can decide based on that whether you want to hire me to be your due diligence guy through my publications, other publications.
That's good. That's good. Well, you all, there's nothing to lose in that, right? One email a week, free weekly digest by Lobo Tiggre. And so appreciate you for coming on the show. And there's a lot of commodities that I wanted to jump into, but hopefully we can have you back to be able to expand on some of the other commodities in the space. Thank you.
Sure thing. Next time, look forward to it.